Hiya, Eoin McGee, financial planner here. Just come off air with Ciara and we're here on Facebook Live to take some of your questions. We have loads from the ones we didn't get to on air, but please keep sending them in. We'll keep going through them for as long as we can. The other thing for listeners this week, what I wanted to tell you about was I have a seminar coming up on May 11th in the Liffey Valley Clayton Hotel. It's in conjunction with enough.ie, and Newstalk listeners can get a discounted ticket by using the promo code Newstalk. But let's jump into the first question. Let's get stuck into the questions and see where we go.
Okay, so the first one comes in from Sharon. So what bank do you think is the best one to go for a mortgage with?
The bank to go, the best mortgage that you can get for you is the one that gives you the money that you need. So some people, when they're applying for a mortgage, they need to get one that gives them the most amount of money, or some people, they can get the money they need from all the banks. If you're in that beautiful position where you can get the money you need from all the banks, then it's about rate. It's about getting the cheapest rate you can possibly get. You need to decide if you're going to go fixed and variable and all of that stuff, but you get the best rate you can possibly get. Beyond rate and beyond getting approved the amount that you want and beyond rate, there is one other thing that you need to consider. And this comes from talking to a mortgage broker or an advisor, and you won't get this in the bank itself. We witnessed in 2008, 2009, 2010 and so on, as the property prices started to fall, as people really struggled financially. Some of the banks were much better and much more compassionate about dealing with people who were struggling financially. And some of them were much quicker out of the blocks in terms of setting up teams to help people who were struggling financially. And that to me is something that's very important. Would I give them a plug on air? No, I wouldn't. But just talk to the person who's selling you the mortgage and ask them, what would that company like to deal with when things were going wrong? Because who knows what's going to happen in the future. So to sum that up, you deal with the person who's going to give you the money you need. If you've got a choice of people who are going to give you the money you need, then it comes down to rate. And rate is probably the most important thing that you need to consider.
Okay, so this comes in from Lauren. So she wants to know, are loans considered bad debts? I've heard conflicting points. Some say it shows your ability to repay.
Are loans considered bad debts? I call anything that's not a mortgage, so a car loan, a personal loan, a credit card, anything, I call that crappy debt, because it's generally stuff that you use to buy things that are either experiences or things that depreciate in value, like cars. A car that's 10,000 euros today will only be worth 8,000 euros next year, so it's a depreciating asset. The question is, though, I think what the question has been asked is, when it comes to going for a mortgage, does it impact you negatively? Of course it does. It's not impacting you negatively because you've had loans and you've paid them off. But where it impacts you, and this might be where the conflict is coming from, where you're getting conflicting advice. Where it impacts you is that whatever you're paying on the month-to-month repayments on that loan reduces what you can pay on a month-to-month towards the mortgage. And that means it reduces your ability to borrow. So having a loan and paying it back, yeah, it can have positive things in terms of your credit score and all of that stuff. But actually, if you still have that loan and you carry it into the mortgage, the loan repayment itself is the big problem. I have seen cases where people would have an 8,000 euro loan and only 8,000 euros outstanding on the loan, and it might reduce the loan amount that they can borrow by 40 or 50 or 60,000 euros. Like, it can have a huge impact, because what they're looking at is how much does that loan cost you on a month-to-month basis, and they deduct that from how much you can afford to pay in a mortgage on a month-to-month basis. So you're getting conflicting because it depends on what side of the coin you're looking at. But paying loans, clearing them off, can be good for your credit. There's no doubt about that.
Okay, so this comes in from Noreen. So besides €3,000 allowance, any tax-free way to give money to children and family members before you die?
Okay, so this is someone who obviously has some spare cash. They want to give it over to the kids. So one of the things you can do is everybody, and they mentioned it already, but everybody in the state can give anybody else in the state €3,000 per year without any tax implications. A parent can give a child €320,000 during their lifetime, and there'll be no tax implications on that as well. What people, when they're going over the 320, and you might say 320,000, that's a huge amount of money. Now, that's from your mother and your father combined, can give you a total of 320. But think about house prices. Think about if they have a pension fund, or if you have a pension fund, and think about all the savings and investments that you might have that are all going to be passed to your next of kin. The 320,000 euros can be eaten up very quickly. If you want to give the money on a year-to-year basis, there's a couple of other things. If you're a farmer, you can use some agricultural relief. If you own a business and you want to get them to work in the business, there's huge reliefs to keep those businesses vibrant and running if you pass on the businesses to your next of kin. The other way of doing it is it's not just 3,000. If you are lucky enough to have a partner, like if you are mama and dad, you can both give €3,000. So it's €6,000 from mother and father to son or daughter. But then you can give to grandkids, and you can give to mother, daughters-in-law or sons-in-law. So remember, it's €3,000 to anyone, and you can be very quickly starting to build that up. You might say €3,000, but imagine if you were really clever about that and you started doing it very early on. If you're doing €6,000 a year from the husband and the wife down to the son, let's say, just to keep it simple, €6,000 a year, every year after 10 years, that's €60,000. After 20 years, it's €120,000. And that doesn't come out of the €320,000 allowance. That's separate. It's completely different. Inheritance tax planning, gifting, gift tax, acquisitions tax, all of these things are very complex areas. It's getting narrower and narrower what you can do with it. But there are things you can still do, but we've touched on them all there, and it's just about getting some advice about that. There is a catch-all here. There is a thing where you say, I'm worried about if I die that the kids are going to end up paying a huge amount of tax on this. And you can use what's called a Section 72 policy, which covers the tax, or a certain amount of the tax depending on how much you take out. But that just pays the tax bill, and the kids will receive the stuff tax paid. There's also things like Section 73 policies, which are savings policies, which can do something similar. But in general, you're talking about agricultural relief, business relief, using the small gift tax allowance on a year-to-year basis, and then just trying to manage the assets in a good way.
Okay, so this comes in from Brendan. So can you take a break from your tracker mortgage? My wife is taking unpaid leave and we need to save for a creche.
Okay, saving for a creche, you want to take a break from your tracker mortgage. The rate that you pay on your mortgage hasn't actually got a connection with whether or not you can take what's called a moratorium. And a moratorium is where you write to the bank and it's all agreed in advance. It's not just I don't pay the mortgage next month. You write to the bank and you say, we've just had a child, or this is happening, or that's happening, and what we need to do is we need to take 3 months off the mortgage or 6 months off the mortgage. That has nothing to do whether you have a tracker rate or you have a fixed rate or you have a variable rate. It's whether or not the terms and conditions of the mortgage that you took out and you signed up to allow for a 3-month break or a 6-month break. Expect to be asked what colour your underpants are and what you had for breakfast this morning when you're filling out their forms to apply for this thing. They'll want to know everything to do with your finances in order to approve these things, and they're the hoops you're going to have to go through. I'd have a little bit of a concern around the fact that the idea of this is to save money for a creche fee, and I'd just be worried about the day-to-day ongoing finances for yourself, and maybe you need to take a bigger look at where money is going out to, because saving 3 months or 6 months mortgage to put towards creche fees, the creche fees are probably going to be very long term, and I just hope that's been worked out for you properly. But in general, it doesn't matter if it's a tracker mortgage or not. You need to ring your own bank, ask them is it possible to take a break, and what forms will you need to fill out, and just expect to have to tell them everything about your life. So best of luck with that one.
Okay, so this comes in from Tom. So, hi Owen, we're building our own home in the coming months. We estimate that the cost will be about 370,000. I currently have 300,000 saved. Do I clear out my savings to build the house and avoid borrowing money, aka a mortgage, or should I keep my savings and get the mortgage, which will cost about 70k over the life of the mortgage?
Okay, so you've actually got a big chunk of cash and you're wondering, should you get a mortgage to build a house or use your savings to build a house? You've already calculated, and let's just assume that your figures are bang on correct, because I've no reason to believe they're not, that you've already calculated that if you get a mortgage, you're going to pay €70,000 in interest over the life of that mortgage, and that's how much the bank is going to make out of it. The question you need to ask yourself is if you used that money and invested it yourself, after tax, could you get more than €70,000 on it over the same period of time that you're looking on the mortgage? Depending on what the mortgage rate is, and we touched on this when we were live on air on the radio earlier on, but what I would say is depending on the mortgage rate that you have. So if the mortgage rate is 2.5% or 3%, what you really need to do is you need to double the mortgage rate to allow for tax, and it's not as much as double, but just to keep it simple, double the mortgage rate. So if the rate is 2.5%, 5% is now your target. Can you get more than 5% growth per annum before, if you can get more than 5% per annum, well then it might be a better idea to put it into savings and not to use the mortgage, or to get a mortgage and not to use up your savings? It's a very specific question though, and this is a really difficult one to answer in an environment like this, because if we were doing this for a private client, what we would do is we would look at everything to do with that person's finances. We'd map it out and we'd establish exactly what that person's date of financial independence is. Now, financial independence is the day in your life, and everybody has one, where you've created enough wealth that you don't have to work again, you don't have to worry about money. Now, let's imagine that yours is 63 years of age. Just make it up. Yours is 63 years of age. What we would then map onto that is, what if I get a mortgage? Does it become 65 or does it become 61? Or what if I invest the money? What effect does it have? Because then what we have is we've a tangible way of looking at your decisions today and the impact they're having on your long-term financial future. So it's a very specific question, but try and keep it as simple as possible. If you can get more return on the money you have available to you today than you're going to pay in interest after tax, go for it. And if you don't think you can, don't. You also have to sleep at night, and some people won't sleep with a big mortgage repayment coming out of their bank account every month, so take that into account too.
Okay, so this comes in from Jared. So why did the revenue commissioners fail to send you a balance account of tax paid the previous year?
Why do the revenue commissioners not tell you that the revenue commissioners owe you money? I have no idea why the revenue wouldn't flag that to you. There is thousands and hundreds and millions of thousands that go unclaimed every year. In fact, there's one of the online companies here in Ireland has done some research, and they suggest that the average PAYE worker gets just over €900 in tax back if they bothered to do a return. It's not up to revenue. Maybe you should say this. They've actually got a little bit better about some of this in very specific areas. Did you know you should have or you could have? And they've been very targeted about it. But there's nothing to stop anybody picking up the phone to their local tax office and asking for a balancing statement. That's what you need. And all that does is it looks at the taxes and the way your tax, and particularly if you're married, the way your tax credits were applied last year, and it'll tell you if you're due a refund. And in fact, if you are due a refund, what will happen is that will come out automatically with it. So request a balancing statement yourself. Don't rely on someone who possibly owes you money ringing you up or writing to you to tell you, I might owe you money. You got to be proactive about this stuff yourself.
Okay, so this is from Helen. So myself and my husband are taxed as single people. How do I change this? Plus get more tax credits as he's on higher wage.
Okay, again, it's funny, this kind of consistency, because on air someone was asking, should they get married to avail of the tax benefits? The thing about it is when you're married, you can share tax credits. You can share a certain amount of them, and tax allowances a certain amount of them. So you can kind of figure it out who's best off having most of the credits. If you're both paying tax at the higher rate of tax, it's unlikely that there's going to be a major advantage to actually sharing your tax credits in that way. Still can be useful for years where maybe you have a month or two where you're off sick or something changes. It can be very useful, and there's no disadvantage to you to being jointly assessed. The only thing I'd say about it is if you're on if one of you pays tax at the higher rate and one of you pays tax at the lower rate, you need to make sure you're using up all the amount of income that you're allowed to have at the lower rate. And if you're not, try and pass that over to the person who's paying it at the higher rate. So in very simple terms, yeah, you should put it together, but there's less benefit when you both already pay tax at the higher rate of tax. I think that probably answers that question.
So this is the last question. It comes in from Ben. So can I get a home equity backed loan? I am a semi-retired 60-year-old who's married with no debts and over 400k equity in the family home.
Okay, so you're talking about home equity release loan. What these are loans where you're maybe retired already, or you're certainly you're generally over 50, sometimes even over 50, over 60, sometimes even over 70 years of age. And what you've done is you don't have what they would call an ability to repay. So maybe your income is stopped or you're on a pension and you can't approach a standard high street bank and ask them for a mortgage. What these companies do is they give you some money up front and they don't look for repayments on a month-to-month basis. And what happens is the interest that they charge you gets added on to the loan amount that's outstanding. So you borrow €100,000 this year, and let's just keep it really simple. Imagine there's €5,000 in interest, and I'm not suggesting that's what it is, but imagine there's 5,000. At the end of year one, you'll owe them 105. At the end of year two, you'll owe them 105 plus the interest, so 110.5, and so on and so forth. And it's compounding up the interest. Now, a lot of these contracts, what they do is that when you do ultimately pass away, they sell your home and your estate is forced to sell the house, or the people who are receiving money from you, like your kids, have to repay the loan themselves, either by selling them the house or coming up with the money themselves, and they get their money back plus the interest. This interest does accumulate up really, really quickly. It's not an area that I'd be strongly encouraging people to go into, but some people are really stuck. 10 years ago, there was several lenders in the Irish market. There was 3 or 4 at least that I can think off the top of my head that were doing these home equity release loans. There is one who has just been approved, I believe, or is in the process of being approved through the Central Bank of Ireland, and I think is expected to be back out in the market in July. You will be able to get a clear definition of, if you die in 5 years, if you die in 10 years, if you die in 20 years, how much will be outstanding on the loan. And a lot of these companies will build a clause in that says the value of the loan will never be greater than the sale value of your house. So the family will never be chased for more than the value of the house. But just tread really, really carefully with these loans, because I have come across people who have them and they have them 10 years and the interest is accumulating up, and they really feel a burden at a time in their life when they shouldn't feel burdened by it. But make sure it's good for you, make sure it works for you, and make sure you have all the facts before you decide to go ahead with it. I think that's all our questions for today. Just to remind people, get on to enough.ie and have a look at the seminar. Use the promo code Newstalk. The seminar is on the 11th of May in the Liffey Valley Clayton Hotel, and we'll hope to be back with Facebook Live soon for these questions. Thank you.